Me, guys, this week, earnings season continues to rage on, and there are a lot of fun company-specific stories on tap. AMC, of course, is a name I'm watching, but also some of these SPAC companies are now going to start reporting results. Recent SPACs, SoFi, out earnings. How has it been doing as a public company? Lordstown has been a full-on disaster. How are they doing? Do they have enough cash on their balance sheet to survive into year-end? 23andMe reports earnings on Friday. That is a company that has been losing money. Can they suggest that they will turn profitable sometime in our lifetime?
You know, and this is big week for the so-called memes, too. You mentioned some of them. AMC reports out to close today. Coinbase, which is meme-ish. If
we'll
call it a meme. Okay, it's out tomorrow. 23andMe, I mean, I think, SPACs and memes are sort of separate. Sometimes they interconnect. Palantir reports this week also. So a lot of these sort of buzzy names.
Bumble too.
Clover.
Last week, Match.com, they disappointed. How did Bumble do? Is it Bumble taking share from Match? Again, another interesting story. Investors have to pay attention.
We got Hims on there as well. That was another SPAC.
Hims and Hers, yeah. They'll be on later in the week with us.
Big week for chicken. We had chicken deal. Tyson out with its results.
Wendy's, too. Big proponent of chicken sandwiches.
And then, there is Disney on there. Real company.
Disney,
Real company on there amid all the other nonsense. I mean, what has continued to be the story through earnings season is not only are stocks moving significantly more than the market, but we continue to see the market not rewarding companies that come out and beat on the top and the bottom line. And yet, as you noted, Julie, the market continues itself to grind higher. And that's that rotation within the market, leadership moving around different groups. Last week, we actually saw a couple of very nice days for the cyclicals, with rates moving higher on the back of some of those comments that we heard from Jay Powell 2 weeks ago. And then we get that jobs report. And now we're thinking about maybe an easier Fed here and an economy that is holding in a little bit better than expected. And all of a sudden, you see financials, taking the lead for a few days. Of course, that's going to be under pressure today with energy under pressure, with oil prices down. But it continues to be the case that the market, the S&P 500 level itself, tells a dramatically different story than what the average constituent tells you, which is a different condition than the market was in, let's call it January, February, when pretty much everything except Apple went up, right?
What's interesting about Disney, by the way, is that it sort of straddles a lot of those different parts of the rotation, right? On the one hand, of course, it has this streaming business that is paying a lot of attention to these days, which benefits from people staying at home more. On the other hand, it has the parks, which suffered through the pandemic, and I imagine they'll be getting some questions on the call about the Delta variant and what that's going to mean for that part of the business, even if it maybe benefits the streaming side of the business. And then, of course, I imagine Disney's going to talk about inflation, too. I mean, even when there was no inflation elsewhere, there was inflation in Disney park prices. So it'll be interesting to see what they have to say.
Yeah, the attendance in Disney parks, it's heavily tracked on Wall Street. It looks like it has come under a little pressure as the variant has spread. But the movie part of the business, I am really curious on how that does. Cinemark, their earnings call last week was very, very interesting, saying that their business in some areas, in some states, are back to pre-pandemic levels, that people go back to and watch movies. That is very interesting. But Myles, Hims is a real company. I use their shampoo. Stuff is great. Tingles. It's awesome.
Disney back to Hims.
Yeah, no, I was just thinking about it. That stuff is great, man.
No experience with Hims. Yeah. The other thing with Disney as well is what to make of the cable business in there. We heard, a little bit last week from Viacom. Of course, they lapped second quarter of 2020 when there basically were no sports. And Disney has had an interesting quarter. They had most of the NBA playoffs. The finals finished just at the beginning of Q3, but most of the NBA playoffs were a Q2 event for them. And then, how are they thinking about the upcoming football season? We talked a little bit on the call this morning about, does the spread of the Delta variant change football? I don't really think that's a target audience crossover there, where that's a group that is going to be deterred by, the pandemic. But, we'll see how the football powers that be think about it.
And to take a step back for a minute, I know, Brian, you were crunching some of the numbers this morning on how many companies that have reported thus far have beat estimates. And it's a pretty high beat rate, although to Myles' point, it hasn't necessarily mattered in every case.
Yeah, FactSet tracks this. What is it? 87% of the companies have beaten.
I've got it here. So we've got 88% of companies, or 89% of companies, the S&P 500 have reported results. 87% of those companies have reported a beat relative to estimates, and the overall earnings growth for the S&P 500 is tracking at 88.8%. So
Although
if
really,
you can keep those
it hasn't
straight,
mattered because a lot of these stocks have sold off on these results.
I know. I'm just trying to, we got a lot of 8s in here.
Yeah. Really what I want to see is what the growth rate is from 2019, right? That's something that we've talked about a lot. Yes, it's 88% from last year, but...
And even alongside these earnings beats, B of A is out with a good note, and I have this story on the Yahoo Finance homepage now. It appears that corporate sentiment has started to peak, and they track very closely how execs are talking about inflation and other trends in their business on these earnings calls, and it appears that sentiment has peaked, and there's starting to be a lot of concern on the street on how second half profit margins will look like because of various inflation, labor, supply chain, you name it, and do estimates have to come down even more, which of course would pressure stocks.
And by the way, speaking about inflation, as we look ahead to this week, as we look ahead to earnings, we got to mention inflation data, which is out on Wednesday. Yep. We've got the consumer price index that is expected that day for the month of July. Month over month, we're looking at 0.5% increase year over year at 5.3%. But if you look at the core, 4.3%. So that is a number that always gets a lot of attention that I'm sure we will be talking about. And as we've talked about, that's what companies have been talking about on their calls as well.
And just to go back to those 19 numbers, so right now S&P earnings for the second quarter, basically about to come in around $51 for the overall index. In the second quarter of 2019, it was $41. So 25% increase relative to 2019. And I think, last week we had Goldman Sachs coming out, upgrading their price target. This morning, Credit Suisse comes out. They put a 2022 price target on the S&P of 5,000. And I think that theme, the top-down strategy type theme of are analysts, strategists too conservative continues to be yes. I mean, right now, the overall estimates for what third and fourth quarter earnings for the S&P 500 will be puts full year earnings at about $205. But we've seen over the last 2 quarters, analysts were at least 10% conservative relative to where we came in. So if you get a 10% beat on third quarter, fourth quarter earnings, which right now are estimated for $52, $53, you're looking at closer to $220 in earnings for the S&P 500 this year. And you have bullish strategists talking about 217 next year. So I think overall, maybe what's really bolstering the index is that everyone remains too conservative. And is that a bottom up story? Is it a top down? Ultimately, there continues to be too much conservatism from, the folks who are guesstimating all these results.
One target that stood out to me in my weekend reading, 3,800, B of A looking at for 3,800 on the S&P 500 to year end. That's about a 14% dip from current levels.
But where is that coming from, though?
Yeah.
No, I'm asking, like, they say it's multiple compression, right? So their view is that rates are going to be going materially higher, thus making it challenging to put a 21 or 22 on the S&P.
Yeah, it's hard to keep that target right now. When you see a Goldman at 4,700, B of A at 3,800, I mean, that is the range.
I think it's hard to keep the target because the S&P is at 40, 42, 44, whatever we're at this morning. Record highs,
Yeah, so. Well, as you say, conservatism has not been correct in this environment, by and large.
And you don't get in trouble for being too conservative on earnings overall, because generally earnings get revised down as you go through any one quarter, and generally strategists end up being too optimistic. But we have a 6% economy. Are we going to go back to a 2%, 1.5% economy next year? Are you telling me that an S&P 500 overweighted to technology, where the 5 biggest companies are worth trillions of dollars, churning out profits every quarter, exerting tremendous operating leverage over this cycle, are those companies going to all of a sudden start reporting poor results, and now we're going to end up with huge earnings misses? I just don't see it.
Well, I guess a few people do out there.
That's fine. That's their job, not mine. I'm just in the cheap seats.
Exactly.